Welcome to the Tote the Note podcast hosted by Jim Rhoads, founder and head coach at the Octane Group. Join us while we dive into the questions that matter most to buy here, pay here operators in the world of subprime auto finance. This episode is brought to you by our friends at Neo. And now, here's your host, Jim Rhoads.
Welcome, everyone, to the Tote the Note podcast. We're thrilled today to have distinguished guest Brent Carmichael joining us again. He's a regular co-moderator, co-presenter, co-speaker, whatever we want to call him, with the Tote the Note series. And we're grateful, Brent, that you're able to come and bring your expertise to the conversation. And of course, many of you recognize on the screen Steve Levine, who is the attorney with Ignite Consulting Partners, longtime expert in the compliance arena. How long have you been doing this, Steve?
Oh gosh, I hate to admit it, about 30 years.
Wow. Yeah. I was gonna say, you've been doing it since I've known you. It's been a good while
I've dated myself.
Yeah. And obviously the compliance world has changed a ton. That's what we're here to talk about. Our theme for today is, how to be compliant in the area of underwriting. So this is an interesting thing for me because as a former dealer myself, I watch how dealers are out there. We watch these same conversations on Facebook and social media, Steve, that you see, and just, I saw you say recently, it's good that people keep you in business. Like there's folks around who need compliance attorneys, right? There's no shortage of work for folks like you. But I think what we want to try to do today is to help dealers understand, okay, what can I navigate in the underwriting space? How can I be flexible, as a buy here, pay here dealer, which is one of the things I've always said, Brent, is one of the things that I love about the buy here, pay here space is that ability to be flexible. At the end of the day, we're out there providing an unconventional finance solution. So now we got to figure out how can we be at least conventional enough to be compliant. And so this should be a fun conversation. And I think, Steve, you can just kind of share your background as it relates to underwriting in particular. I know you cover all aspects of compliance, but you want to talk about that part of it first?
Yeah, I mean, certainly we get a lot of questions about underwriting, and I'm here to tell you, I think you can have the best of both worlds. I think you can have a written policy that is objective and sets forth the criteria, while at the same time leaving the dealer the ability to make decisions and run their business the way they see fit. What I look for, if somebody tells me they have a policy and then tells me they're making 3 exceptions a day, well, that's not a policy.
Right.
So there is a way to balance it all.
Yeah. So Brent, I know you got a lot of questions in there. Before you jump in there, I'll explain that Brent, for those who don't know him, is a consultant and longtime moderator, 15 years now with NCM, one of the most prestigious firms in the business of 20 groups. And so, Brent, you're bound to have questions for Steve.
Well, and I was going to say just right off the bat, Steve, do you like the word policy or do you like the word guideline better when it comes to underwriting? Because policy seems almost the black and white, right? I kind of got to do it this way. But would you prefer us to have guidelines as opposed to policies when it comes to underwriting? I
actually want to see you have a policy, but because I think that's what regulators and auditors expect to see. Okay. So I think it's important to have that. Now, if you want to have some additional guidelines or if you want your policy to kind of go into detail and do a little bit of both, I think that's okay too. But I think your aspiration has to be a policy.
Good. Okay. And then I would also like to follow up just to make sure when we talk about auditors and regulators, like who are they? Who would be the ones who would be governing this particular aspect of our business?
Well, you have the CFPB at the federal level. You certainly have a lot of state regulators that are interested, especially when discrimination claims are made. More importantly, and some things I think that dealers overlook this is their capital provider wants to see their underwriting policy, and they're going to audit them to that policy as well.
Right.
Not to mention, again, if certain allegations are made, you may have a plaintiff's lawyer that's digging into that policy. So it may have a lot of eyes on it. So it's important to have something that means what it says.
Yeah, that's a lot, Brent. What did you hear in that?
Well, I guess my question would be, and again, I'm going to put my dealer hat on here a little bit. Really, what are my chances, Steve, of really getting in trouble for this? I mean, are you hearing, or have you heard, or have you seen regulators that went into a dealership, buy here, pay your finance company, whatever, specifically for their underwriting as the lead reason they were there? Or is it typically one of those, they kind of got in trouble for something else first, and then they looked at that while they were there?
So I think there's actually a couple of different answers to that question. As compared to, say, 10 years ago, yes, I think this is a much bigger issue that regulators are looking at. A regulator that shows up, so say it's a state regulator that comes in every couple of years and does an examination, that's what they do. I don't think they're going to be digging through your underwriting policies. Unless there have been complaints made about maybe whether they be discrimination complaints or complaints about the rates being used, then maybe.
Okay.
On the other hand, you've got, especially, there are some state regulators right now that are all over this, and I personally think that they're trying to find things that they have a certain view of the industry, that they don't particularly look at the industry very favorably. And this is one of the issues that they like to get into. So, for instance, if you're in the Northeast, I think you've got a lot of state regulators that are more likely to want to talk about your underwriting policy. If you're in other parts of the country, not so much. So it's not one size fits all. Depends where you are.
And again, I don't want to minimize the importance of underwriting compliance, but I try to stay up with the trades as much as possible. And typically when a finance company has gotten in trouble, it's for something else first that they went in for first. It was some other complaint, and then they got into the underwriting side of it and found that they were making more exceptions than what they were supposed to or not. And I get the question a lot. I mean, it's like, how important is this, Brent? How often? I mean, is a regulator really just going to come in just out of the blue and just want to see my underwriting guidelines? And what I tell them is what you've always told me. Yeah, you need to be prepared for that. I mean, you need to be ready that they're just going to show up at your doorstep and want to take a look at these things. So don't assume you have to get in trouble for something else first, I guess.
And then I'll tell you that the CAC lawsuit that the CFPB brought, that the New York AG, Massachusetts has brought similar, that there's been a couple of other states that they're getting into underwriting because at the heart of it, they are looking for discrimination.
That's the third time I've heard that word.
Yeah.
Yeah. And so that's what I think about with underwriting. I think is, how am I going about, if I'm a dealer over there, I'm a dealer creditor, right? I'm making this decision. So how do I go about that, without the appearance of discrimination? And, Brent and I are quite familiar with some of the underwriting softwares out there that are quite good. And they're definitely solving a lot of what would be compliance problems, because they're making sure that they're compliant in that. But I like the idea of having this guideline or policy where I can follow that software. I write the policies into that software. I stick with that process. And then I have an exception making process, right? Because you're going to make exceptions to your policy or your guideline, but your policy or your process for making exceptions is pretty clear. Wouldn't that help me?
That would absolutely help you. And if you've got some sort of tool that you're using, say that in the policy.
Right.
I love those tools. I think they're very beneficial to a dealer. I think it really takes them out of the danger of subjectivity.
Right.
The trick is, I tell this to folks all the time. If you're going to go that direction, you have to listen to it.
Yeah.
You just can't listen to it when you want to listen to it.
Yeah. Amen.
Well, and you got to be consistent in how you use those as well, because I know you've seen this, Steve. I have. I'm looking through their scoring system and I look at the application. Well, wait a minute, this probably really should have been graded here and not here. Yeah. And then I'll find another application where it is scored that way. So then we have to have the conversation with the dealer. Look, you guys got to sit down and go over the definitions within your scoring system and make sure everybody's on the same page, because Steve scored it this way, Jim scored it this way, and it's the exact same basically application that we've seen there. So something I've seen probably more too often than I should have. is I've had to put that in a recommendation that, hey, it's time to review the definitions of your scoring system and make sure everybody understands what they are supposed to be.
Yeah, and Brent, that's a great point. A lot of times I've seen companies implement a scoring solution, and the owner's happy as a clam. But they didn't train the underwriters actually making the decisions, and there could be disconnects, 6 months, a year later, that only get picked upon when you do the audit. So you really have to make sure when you go in this direction, train them and then train them again.
Yeah. So I think from over here, Brent, as a consultant advisor, much like what you do, I'm always super clear about, we don't do accounting and we don't do legal. So when the people ask me, anything in the sphere of legal, I just say, won't you call Steve? Let me get you his number in Fort Worth and talk to him about the legal side, because we stay away from that. However, we're trying to obviously advise folks operationally in a way that will keep them compliant. And so that's where I wonder, I'm not as familiar with the safeguards rule and some of the things that would have come before that. So am I to understand that we're supposed to have on our team somebody who's designated as our compliance person, and they would also probably need to oversee this underwriting process? Am I right?
I think partially. Yes, you should have somebody. I don't care whether it's a small dealership with just a couple of people. You should have somebody that you could point to and say, yes, they are accountable for compliance. Okay. Doesn't necessarily need to be the same person that handles your underwriting, as long as there's some sort of familiarity where the compliance person understands the basic underwriting concepts and how things work. And vice versa, whoever's doing your underwriting leadership has to know a couple of things about compliance to where the landmines are.
Okay. So going back to this thing about flexibility, if I'm this buy here, pay here dealer out there in, Middletown, Pennsylvania or whatever, I'm trying to figure out how can I look at the book and I see my guidelines and it says I'm trying to stick to 6 months on the job and certain credit profile, but I've got this person here who, maybe is an exception one way or the other. You would recommend that they proceed how, based on the checklist, so to speak, whether that's on a paper checklist or in a sophisticated software. They've got this guideline that they've created, this policy. How would you recommend they go about making those exceptions?
So I think the first thing that folks need to understand is exception logs are very important. That they could really save you if there's any sort of question down the road. And, I preach this to our clients, and it's always easier said than done, that they may develop good habits for a couple of weeks or a couple of months, but then inevitably the exception log kind of falls by the wayside. That's why one of the things that I encourage folks to do is I love quarterly compliance meetings. Anybody that's heard me speak has heard me talk about quarterly compliance meetings. One of the things you talk about in those meetings is, okay, let's break out the exception log. Are we making exceptions? What's the commonality for those exceptions? Okay. Do we need to change our policy because we're calling them exceptions, but apparently this is now part of our policy and we need to change our policy? Gotcha. And that becomes important because if you ever have to defend yourself, you're able to show we did make an exception. We recognized it as an exception, and here's why we made it. Maybe they had more down payment. Maybe there was a reason they switched jobs, whatever it is. And if you do that, you're greatly diminishing your risk of somebody coming in and saying, well, you see, this is proof that they're not even following their own policy.
Yeah, I think.
What is an exception, though, Steve? I mean, real quick. I'm sorry, Jim. What would be considered an exception? I mean, very few dealers I know have literally black and white. Well, they don't even have, most of them don't have it in writing in the first place, right? That they don't say, we're going to do this, right? We don't want to do, we're 42 months. Well, if I do 43 months, is that an exception? On a one-time deal? I mean, would that be considered an exception?
I do think it's an exception because you said 42 months is the policy. For instance, if you say that our minimum down payment is 500 and you decide to take 400, that's an exception. If you say that we need to show stability of this much time at the residence, and then you get less than that, and you look at the totality of the application, and you want to do that deal, you code it as an exception. and why are you making that exception?
Okay, I'm going to put my dealer hat back on now. I'm going to have the longest exception log in recorded history because we all know that when it comes to buy here, pay here underwriting, the only black and white policy is it depends, right? Because it does. It just depends on everything. How much money they have down, how much the car, all of this stuff is an all it's depends kind of thing. That's why I'm going to go back to my earlier question with, do you like policy or do you like guidelines? See, I don't have exceptions typically in a guideline, right? I do have exceptions of policies. So should we have, and again, it's semantics, I get it. But the top of my document to me would be underwriting guidelines that keep from having to, and this is going to sound bad because this is my dealer hat again. I'm probably going to go to jail for this. And I don't want to have to worry about that exception thing, right? If I say, we like our terms to not exceed 42 months. And if I go 43, to me, that's not an exception because I like it. I don't put it in black and white that we only do 42 months and that we only do $500 down kind of thing. So,
well, I think you could accomplish the same thing in a policy. You could say that we have a $500 minimum. We will consider exceptions based on mitigating factors. I think you could leave yourself room and still have it be a policy.
Yeah. Now, and that's what I'm looking for there, because again, you go around any of my 20 groups and you say, okay, and we've done this underwriting survey thing in the past, and it's like, minimum down of 500. So if somebody came in with 400, you wouldn't take it. Well, yeah, it depends, right? So I know there's people out there listening going, well, wait a minute. I mean, I may take less than 500. So what is if I put down my minimum down is 100. Well, if somebody comes in with 75, will you take it? Yeah, it depends kind of thing. I think that's kind of where the struggle with underwriting policies is we think it is kind of a black and white that if I put 500, then I can't take less. Or if I do, I really have to be able to explain that.
I think
and you can explain it. The thing I hate to see is I asked to see an exception log, and it scrolls, goes on forever, and that's when, okay, guys, we need to rewrite the policy. Because the exceptions are overruling the policy.
Yeah, I think Brent's enjoying putting his dealer hat on. I'm going to put an auditor hat on for just a minute, and I'm going to pretend that I show up at one of Brent's dealerships, one of his clients or his 20 group members, and I'm going to ask, okay, I see these exceptions. I see that you're trying to be flexible and help people in the community, and you have this policy I see, but you consistently make exceptions for customers, and you let some customers in with an exception at $350 down. But what about this customer here who meets all the checklist and you turned them down? Like, what's the story behind this one you passed on? So that's what I'd like to understand. What do you think, Steve?
Yeah, I think in that case, you use a scoring system for that reason. And like I said at the very beginning, if you use a scoring system, you need to do what the scoring system says, and not, a lot of times I see tension when folks get on a scoring system. Well, it's not intuitive to what I would have done, so I'm going to make all these exceptions, and that's where you run into that subjective risk. Sure. Now, if you're not using a scoring system, again, I think it comes down to making sure that the content of the policy itself gives you enough room there. And let's face it, a lot of this discussion is going to take place after the horse has left the barn. The auditor shows up or the regular shows up, and they've got this preconceived notion that, well, the customer thinks that they were discriminated against or something didn't go in their favor, and you almost have to prove, no, it did. We followed our policy. Right. And to be able to make that argument, the more data and information you have available, the better.
Right.
So you don't have to go back, try to remember, what was I thinking on this deal a year ago?
Yeah. And I think what I'm hearing, Brent, is that, we're not likely to have an auditor knocking on our door unless there have been complaints. But if they did show up, they're probably looking through a lens of discrimination. They're looking for primarily some evidence of discrimination, perhaps some other things we haven't really addressed here. But that just lends me to think that I need to be mindful of that if I'm a dealer, if I'm the director of the underwriting department. I need to be mindful of those things because I want to make sure that I'm consistent across the board. I don't have anything that looks like favoritism, right? So that's kind of where I'm thinking we're probably able to stay safe. And I think then, Steve, I'm trying to figure out, okay, so I have somebody who meets my checklist. They score an A in my system, or they check all the boxes, but I have some other reason that I've observed something, or I've discovered something in my, due diligence, or whatever we want to call that, in the approval process, and I'm uncomfortable. So how can I operate from a place of insecurity? Like, Brent, I'm sure you're familiar. I've seen contracts, and I used to try to have one in my own contracts as a dealer that just said, if I feel unsecure, there's some basis for insecurity. Got information that customers leaving the town with collateral, or moving or destroying the collateral, whatever. So there's some basis for insecurity in the contract. But at the point of the underwriting approval, is there such a thing as finding something that just makes me insecure?
I think you could do that as long as you are being objective.
Okay.
It can't be based on their age or religion or color and anything like that. National origin, things like that. But if it is, they've had a repossession within the last X, or I heard from so and so dealer that they repossessed the car and it was in shambles. If they tell you certain things in the conversation that leads you to believe that they're going to abuse the collateral or take it someplace you don't want to take it, those are all valid reasons.
Yeah.
But it can't be for any protected class reasons.
I think the part that is interesting me to Brent is like, okay, I'm a Texas dealer, and I've got this person here whose application says they've lived in Texas all their life, but they got a Minnesota accent. It's like, those are the kind of things that are like, what am I to do? I'm almost obligated to provide the financing, you see? So that's why I'm trying to, what do you think, Brent?
Well, and the one thing that I challenge the dealers that I work with is I don't like the underwriter to ever actually see or talk to the customer at all. Because if you think about and I'll just go to the top, Ford Motor Credit, GMAC, Exeter, none of them ever see or talk to the customer at all. They base their decisions solely on the information and the data provided.
Mm-hmm.
And I think that kind of takes out not only the subjectivity, but the opportunity to discriminate at that point. Jim, you've been around. I've sat across from a customer that was the nicest yes, sir, no, sir, in the whole wide world, and looked crappy on paper. Short job, short res, didn't make very much money. I know Steve's going to make this payment, sell him a car, never see him again.
Yeah.
And then I've had that customer in there that's dropping the F-bomb right and left, and you just go, this guy is never going to make a payment no matter what, I can just tell. And then you never hear from him again because he makes all of his payments on time. So I think it can lead to discrimination with us sitting down and talking with the customer or seeing the customer, because it can give us a preconceived notion. Some of the questions I've heard them, well, they were tweaking. How do you know?
Yeah.
Right. You don't. They're acting different, but how do you know? So I turned them down because I thought they were using. Well, I don't want to stand up in front of a judge and jury and, throw that one out there, because it would be, excuse me, Mr. Carmichael, or do you happen to be an expert in drug addiction and drug treatment?
Right.
No.
Right.
So, those are the kind of things that worry me. And you kind of mentioned one has a Minnesota accent, but says he lives in Texas all his life. The out-of-state driver's license thing to me is one that really, for some reason, we assume that if somebody hasn't gotten their driver's license switched over, that they're a high risk. And I've had dealers literally tell me, no, we won't sell you a car.
Yeah.
If you don't have an in-state driver's license. And there's some states I get it because you can't register the vehicle without an in-state, but some of the other ones I'm going, and Steve, this would be more of a question for you. I know that's not really technically a Reg B violation, right? Because it doesn't say you can't discriminate based on where their driver's license was issued. But to me, that seems like that would be a compliance issue to literally say, I'm turning you down, again, in a state where you don't have to have a valid in-state driver's license as a dealer to register a vehicle, so to speak, Arizona being one of those, South Carolina, I think, being another one where the dealer can't physically register a car without it. But these other states, man, that seems to me like that's typical.
Well, but what does the policy say? Getting back to how the policy is written, does it say in-state driver's license? And I think a business has a valid business reason for wanting their customers close and being able to find them. So I think you could say in-state driver's license. And in your example about Texas accent and Minnesota driver's license, and the story's just not adding up, nothing you said leads me to believe that there's any sort of discrimination like that. It's just the story's not adding up.
Right.
And I think that's okay too.
Okay.
You can make that decision.
But typically, Jim, in your example, there's going to be something else if we're doing our due diligence as far as the application review that's going to say, yeah, he says he lives with mom and dad and has all his life, but credit report or something else, again, if they don't have that lovely Texas accent that we all love, that would probably lead us to believe that there was something else there with those.
Right. So what I'm hearing is it's probably not appropriate, Steve, to have in my policy manual some sort of a "he ain't from around here" clause. That probably doesn't make sense. Let's talk about marketing for a minute. Like, one of the things we see out there is dealers who have this really broad blanket, marketing approach. It basically says something along the line of everybody rides, or your paycheck is your approval or whatever that sounds like. So how does that complicate the work for you as a compliance attorney?
Hey, boy, yeah, you've hit upon one. I've been wrestling with dealers over this for several years now, because I think that certainly the CFPB, several of the states I mentioned earlier, that this whole ability to repay theory, that it is not enough just to look at income. You have to have confidence in the ability to repay, and certainly if you're saying everybody's approved. Okay. Or your job pay stub is your credit. They're not thinking about that whole bigger picture, and I think that leaves them vulnerable, especially in some of those states that I mentioned.
Yeah, so I wonder then how you would advise, and maybe not just that marketing example, but when you've got somebody who's, especially that situation where we talked about they seem to meet our checklist. I'm going to assume that our checklist is not publicized. I would be advising our dealers to keep that internal, that nobody knows that we're looking for 6 months on the job or 500 down, or aside from our internal team. But when I do have somebody I turn down, what would be the recommendation on the notice of credit decision when we send that out? I'm sure that comes up for you as well.
Yeah, you could go a couple of different directions like that, just depending on the circumstance. But I want to make one thing clear with the whole ability to repay argument, and I don't mean to get on my soapbox, but what I struggle with is CFPB, state regulators, they've given no guidance on what they expect creditors to do. It's just that this theory, well, they don't have the ability to repay, and therefore you're setting them up to fail. But they haven't said that this is what the ratios should be. This is what we expect to see. That this is what the analytics show. So it's addressing a moving target. Right. And like we've seen with a couple of different companies where the regulators go after them, and whatever they were doing wasn't enough. Mm-hmm. But they never told them they should have been doing anything different. Yeah. So I really struggle with giving guidance in this area, because it's such a slippery slope. Yeah. And what does it really mean, ability to repay? I always go back to the fact that I've had this debate with plenty of consumer advocates. At some point, that there's got to be personal accountability on the part of the customer to know their situation and know whether they have the ability to repay or not. Why is it inferred on the creditor that we're the one that has to be tasked with that? When it's the person that's making that choice, it's ultimately their responsibility.
Right. Anything on that, Brent? I got a couple.
No, I just I was going to say, kind of back to Jim's question. If I'm going to turn somebody down for I just don't feel right. I mean, we have to send out an adverse action, and your choices are typically information obtained from a credit reporting agency or information obtained from a third party. Would that be a third party?
I don't think that's a third party. No, I don't.
We haven't really heard anything from anybody. We just got a bad feeling because, again, the accent didn't work out or the way he was acting. So we've still clicked that as third party, which I believe we have to, if they ask in writing, right, we have to produce proof of what we found out or something along those lines. So, the ability to pay thing. And again, most of the dealers that I work with, and Jim, I know most of the ones that you work with as well, have a good internal metric tracking system, so they know they kind of look at their losses. And, I think most of them could validate, hey, the reason that we put them in this much payment is because historically, if we've kept somebody at that percent or less, they have a better chance of performing. Right. We hear the 25% rule, right? 25% in net, no more than car payments, has kind of been proven out. Doesn't say that nobody charges off under 25%, but we know that once you get over that percent, that the severity and the frequency both increase fairly drastically at that point. So, it's not one of those that's, we can't go to the CFPB and say, well, 25% rule because Subprime Analytics says so, and Agora says so, and, NCM says so, and NIADA says so. But I think most of them can fade that you set them up for fail. The hard part is the self-employed, right? The 1099 guys that if they don't have, it's August. How do you get that verification of income? Those are the ones I think could probably be more of a struggle for us to be able to validate that ability to pay on those, because that really is a crapshoot at that point. It's really hard to nail down what do they actually make with that.
Yeah, I think I should have warned our viewers and listeners when we started in here that we might run a little long today because there's a ton of stuff, and as we talk, there's more stuff that comes up that I think about, Steve. We may have to have you back on a future episode to kind of dig into some of these elements, because one of the things that's also happening in our industry, as I hear Brent talk about that, is, we've seen dealers wrestling with this whole new thing around term of loan. And we're hearing about dealers having crazy high car payments, probably because they're trying to fit the same kind of deal into a certain term, I would guess. But we're advising our clients to look first at payment to income, make sure that the payment is comfortable, because customer can't be successful if the payment doesn't fit. And so look at that. But now we've got this weird term thing that we're having to figure out, because if I'm going to let the customer in with a reasonable down payment, keep the payment, comfortable relative to their income, suddenly I've got this crazy term that I want the customer to be successful. I'm probably going to have a conversation with the customer about the term or whatever, but it's like, that's one of the problems we see dealers wrestling with. And I don't expect you to have the answer to that. I'm just saying it's one of the things that we're seeing in this industry of late, is that it's just really a wrestling match to make it all fit.
I totally agree with you. And a lot of times you're going to have bad facts down the road. You're going to have a regulator that looks at this and says, well, the car was already 6 years old when you sold it. You put them in a 72 or even 84-month term. You knew darn well that it was going to go past the mechanical life of the vehicle. Mm-hmm. You could say that on a lot of deals if you look at them one-on-one, but as a practical matter, to get it to be affordable, and they need transportation today. They're not going to be able to go get a car for 48 months. I just think you kind of have to rely on the fact that at some point common sense is going to prevail, and people are going to understand that they were trying to put the deal together for the benefit of the customer.
Yeah.
Well, it always be that way now, but you hope.
Yeah, I think we all hope that. And I think what I generally hear, though, is if we can create a set of policies, keep that internal, and that we clearly document those exceptions when they come up, and we've got a practice of that. And then I think the other piece that I'm hearing is when we do have a customer who seems to meet the checklist, but we have to decline them for some other reason, that we've got some justification in that one's kind of uncomfortable to me still as a former dealer, like having to turn somebody away who seems to meet my checklist. But I still would probably do it, just because at the end of the day, it's our dollars and it's our, our judgment. Right. But I think that when I hear a lot of that, I'm taken back to when I first got in this business, Brent. And I remember hearing about the FDCPA, I think, Fair Debt Collection Practices Act, which applies to the collection side. And we were taught back at the beginning that technically, as dealers who were financing our own retail installment contract, our own goods, we're not technically required to comply with FDCPA, but it was encouraged that we do that because it was the only rule book around. And so we think it's a sensible set of rules anyway. So I'm wondering, in this underwriting realm, are we bound by the same rules as a bank, for example, when we're financing our own inventory? Is it the same set of rules?
It generally is, yeah.
Okay.
Yeah, I mean, you're talking about Fair Credit Reporting Act, FCRA, Credit Opportunity Act. Yeah, you are.
Yeah. So I think what I'm hearing, Brent, is we need to be consistent. We need to avoid anything that looks like discrimination, which I think we all understand. That's sensible. We should all be doing that in our business anyway. And then when we have those exceptions, we should clearly make time to document them. And then maybe we shouldn't make our life more difficult by casting such a wide net on the marketing side. It's been my observation. It's really not necessary to do that, to say everybody rides. So, that as an example, I'm just picking one. I'm not picking on anybody who might have that slogan. I just mean when we cast that wide net in our marketing, now we really don't leave ourselves any place to go. For me, that's uncomfortable. We have to turn somebody down. And I can't believe that. And I've seen it. I mean, I've actually seen dealers who will have to turn customers down for whatever reason. And so that's an uncomfortable place to be if I'm their attorney.
Well, and 100% guaranteed. And I think that falls on customers' deaf ears anymore. I think too many people have done it. And everybody knows that they're not going to be they won't be declined. They'll be approved, but it'll be conditioned. And I know Steve, and I don't like that game either. I played it when I was a dealer back in the late 90s, early 2000s, being the only one in our market that did advertise. Everybody was approved, and we physically did not decline anybody. Mm-hmm. But obviously the condition was pretty steep, which in theory was a decline, but we could hang our hats on, no, we didn't decline Steve.
Right.
We needed $5,000 down on a $49.99 sale price, but he was approved at that point. And I think, like I said, from a marketing standpoint, I think that's kind of fallen on deaf ears with customers anymore. Anyway, I don't like it because I've been around Steve for so long now that I think he just puts you in the crosshairs. I think those are the kind of things. I don't think they come into our dealership looking for that. I think they're just hanging around on the internet. They come across a website that says 100% approved, and they go, I don't see anything here. I don't see with approved credit. I don't see any of that kind of thing there. You know what? I'm free Monday morning. Let me go into that dealer and just see what's going on with that. I think it just puts us in the crosshairs to advertise stuff like that. And again, we don't decline, and I've seen and I've read some of the companies that have gotten in trouble for large down payments. You actually did decline them. Now it's bait and switch. Now it's an advertising compliance issue that you have, and then there's been some fines and punitive damage for doing those kind of things. So I just think stuff like that doesn't, if you want to advertise to our customer, just tell them it's going to be quick and easy.
Yeah, there you go.
Make sure that it's going to be quick and easy, sure. Right at that point, because that's really what they want.
Yeah, quick and painless. Yeah. So I have to believe both of you gentlemen are familiar with Bill May Pother. I believe he's passed away. Yeah. So he, I remember him sharing, and I think Steve, you would probably offer the same advice, is we should probably always as dealers try to avoid having our customers end up in an attorney's office. I mean, that's just
amen, brother.
The strategy is let's not make them, because anybody who can, if they feel wronged, whether it's correct or incorrect, if they feel wronged, then they may choose to engage somebody, or it's pretty easy to file a complaint at the FTC website and all these other places. Pretty easy for a consumer to file a complaint. So I think that's where we just need to be working. I think most dealers out there are, but it's just like, that's where I think we step into dangerous territory when we have that customer who feels like they've been mistreated. And if they happen to have if they're a minority, or they otherwise have, something else that might make a strong case for being wronged or, mistreated, then that's obviously a scenario we want to avoid.
I'll make a general statement. Back when I was doing defense work, I never handled a lawsuit that didn't start out as a complaint.
Yeah. Okay.
And the totality of my experience is, if you give the customer a pathway to ventilate, then they're going to take that pathway.
Right.
If you don't, that's when they wind up going online, causing a social media storm, or going to the regulator. So I tell our clients, feedback at nameofyourdealership.com. Put it on your letters, have a sign at the dealership, give them a pathway.
Yeah.
Put one person in your company in charge of monitoring that. Right. And make sure it's not somebody that thinks they're always right.
Yeah.
Make sure it's somebody that is going to objectively look at what happened here.
Yeah. Very good. Yeah, so I think we're probably at a place, Brent, where we can wrap up. There's obviously plenty more to talk about. We can have Steve back another time, and I look forward to. By the way, Steve, when we get this thing edited and ready to go out to the worldwide interweb, I'd love to have you on the morning show. We can kind of take some of the snippets of this and have a conversation.
Perfect.
To wrap that up. But I
Thank
might
you.
just let our listeners know that we're recording this in April of 2023. So obviously, information can change, and so some of this stuff lives out on the internet for a long time. So just make sure and consult your attorney about whatever the latest regulations might be. And we think that attorney probably should be Steve Levine at Ignite Consulting Partners. So yeah, reach out to him. He knows the space quite well. You heard him say 30 years in the industry, and we certainly see he's out there. And by the way, Steve, I got to take a moment to say, I see you guys giving so generously. You got your Compliance Unleashed coming up. I had the date written down. What are the dates? What are your dates for Compliance Unleashed?
May 22nd to 24th. It is 2 full days of how to protect your business.
Yeah.
It's not boring compliance content. It is how to protect your business.
Yeah. And that one, people can pay and come and be part of that event, which I think is really important for people to make time to do that. But I just want to say too, you guys are out there. So you and Richard are out there generously giving lots of great information. And today is another example of that. And we appreciate you making time to talk.
Oh, thank you so much for the opportunity. This is what we do. We love dealers. We believe in the industry, and anything that we can do to contribute and help, what we want to do.
Yeah. Any closing thoughts there, Brent?
No, I mean, like I said, I think a lot of Steve. He knows that. I have for many, many years, and what they do for the industry. And I'm going to tell on him a little bit here. He does a lot of stuff that he doesn't get paid for. That's all I'm going to say. Yeah. And we greatly appreciate that in the industry, because there aren't a whole lot of people that do that anymore. And what him and Richard do and what they're willing to do. I have quite a few of my dealer clients that use we share clients with Ignite. And like I said, all the respect in the world for Steve and Richard and everything that they do for us.
Yeah, for sure. I think there's at least one more guy that's doing a lot without getting paid. So I find that my bank balance is just, I'm in that group. So yeah.
But his hourly rate, Jim, is a little bit higher than what either one of us could ever ask for.
No, of course I get it. He's very specialized in his expertise. So again, thanks, gentlemen, for making time. We'll wrap up there. And just remember, you can always subscribe. We've got a special playlist over on YouTube. You can subscribe to our YouTube channel, and you can find this information out on your favorite podcast channel. So thanks again for tuning in to Tote the Note.
Thanks for joining us. Please leave a review, and don't forget to subscribe to Tote the Note. And thanks again to our sponsor, Neo. Find them at neoverify.com. Until next time.